It is now my pleasure to turn today's program over to Vinay Nadkarni, Head of Global Business Development. Mr. Nadkarni, the floor is yours.
Thank you, Carol. Good day, everyone. As Carol said, my name is Vinay Nadkarni of Clearbridge Investments. I'm happy to be hosting this call, which we conveniently scheduled after Halloween and the close of a very volatile October for the markets, with my friend and colleague and now fellow father of two, Aram Green, portfolio manager at Clearbridge, and among his duties, portfolio manager on the Clearbridge Select strategy, which he has been managing now for over 10 and a half years. With a 40 Act equivalent, the ticker is LBFIX, that hits its 6-year anniversary at the end of this month. As a way of reminder, Clearbridge is an authentic active manager where we believe portfolios can combine concentration, valuation, and risk management to create a client solution that is significantly different than market-based passive and factor-based solutions. We at Clearbridge truly believe that this strategy is both a differentiated and complementary strategy to passive and factor strategies to use as a tool for portfolio construction. As a quick introduction to the attributes of the Select strategy, one, it's a high active share, high tracking error strategy. The active share versus the Russell 3000 is 97% at the end of September. Tracking error has been in the 7 to 10% range, and thus clients should expect meaningful deviation to its benchmark on a daily, monthly, yearly basis, but with a clear bias towards outperformance. The strategy has outperformed in 9 of the 11 years that Aram has run the strategy. Two, while it is high tracking error, it is not overly concentrated. It's a sweet spot of about 50 to 60 names that utilizes a spectrum or continuum methodology that many of our strategies at Clearbridge employ, with a mix of disruptive, high-growth names powered by industry and company-specific secular tailwinds, durable compounders, and self-help stories that are more atypical in a growth-oriented strategy. It also has the ability to selectively deviate from cash equities, although that is generally less than 10% of the portfolio. Our format will start with moderated Q&A. We took questions that we've received in client meetings over the last few weeks about the markets and our investment process and philosophy. That should take about 20 to 25 minutes, and as we're answering those questions, Aram answers those questions. As Carol said, you can submit questions solely via the WebEx feature, and we'll try to answer as many of those questions as possible within the remaining time. And those who are on the phone, if you want to email your sales contact and try to get those over to you, I'll look at my smartphone during the call and try to get to additional questions there. So Aram, thanks again for being on the call. Maybe we'll just start with, as you can see on the slide there, maybe just a quick overview of the Select strategy since you were around for its formation in 2004, and as we've talked about in the call title, it doesn't neatly fit into a style box. So maybe just give an executive summary of what you think the Select strategy embodies and what you're trying to achieve with the portfolio.
Sure. So the Select strategy was created, as Vinay pointed out, in 2004. It was a derivative strategy off of a traditional long-short equity fund that we were managing at the time. And we created it because there were a number of investors that came to us and said, we really like what you're doing on the long side, and we'd like you to focus on that in terms of your long-term investing and give you select ability to also participate in other things that are not in equities and select ability to short as well. So it was getting down to the fundamental roots of being an investor in a business, spending a tremendous amount of time de-risking each individual business one by one, and building an eclectic portfolio of companies that had forward-looking management teams that had a real sense of sort of where they wanted to take the business and the necessary steps to bring it there, as well as a management team that was keenly focused on the risks and the building blocks of that story as they invested judiciously their own capital to grow the business in a very prudent manner. And so this was a strategy that we built that we thought there were going to be potential times when the strategy was out of favor, but that over the course of a business cycle, these were companies that would really take advantage of their weaker competitors and be very sharp about where they were committing client capital.
So I know, having known you for as long as I have, I know you took an unusual and kind of interesting route to become a portfolio manager, and that you helped co-found a company in your early 20s, went through the joys and pains of trying to bootstrap a concept into a commercial venture. So maybe walk us through that background, how you think it informs you as an investor, and how maybe that puts you on and helps you appreciate or understand the type of decisions that the management teams you're looking to invest in are thinking about, both risk and reward?
Well, while I always had a passion for investing, I really wanted to understand business better, and my goal was to really understand the ins and outs of how a business works. So in 1997, I started a software and technology business with a classmate of mine in university. And as you pointed out, I mean, we really learned a lot about how to take an idea, build a financial business model around that, figure out how much capital we needed to get us to the first stage of development with the company, and raise external capital, and then be prudent about deploying that capital, expanding it as rapidly as possible without overextending ourselves, and really learning a lot about sort of the opportunities and pitfalls of doing that. Hiring some of the right people, hiring some of the wrong people, expanding into geographies that maybe we should have built out more of the core. So there's a lot of valuable lessons that we learned along the way. One of those valuable lessons was an internal valuable lesson, which was I really did enjoy spending the time with our venture capitalists and their other portfolio companies that they had invested in, and spending time with other entrepreneurs to understand how they were developing their business, where they saw opportunity, how they were expanding their companies. And so I pivoted my career in 2001 to be the investor in the entrepreneur rather than being the entrepreneur myself. And it was a great time to start as a de novo investor, because that was right after the dot-com bubble had burst. There was a tremendous amount of dislocation and sort of misunderstanding about technology and a lot of the business models that were still in early stages of gestation, and there was a lot of exit of other investors in that time frame, where there was a shrinking of the overall financial industry, and so there was just less sets of eyes that were looking at these investment opportunities, and a lot of people running away from them. So to kind of pick through the rubble and find the great businesses that maybe were struggling because the industry was under pressure, but that looking out over the next 3-5 years, that these were companies that were really early days of developing their business with very large opportunities in a very different, dynamic, changing environment.
So if you can go to the next slide. I think one of the things that I've spoken to you about is, we're living in a world where there's so much information, it's ubiquitous, right? It's almost infinite. And yet, paradoxically, time horizons and attention spans have gotten even shorter. With people leaning more towards binary, they just want a simple explanation rather than a nuanced explanation, and honestly, less attention being paid to the underlying company fundamentals. So maybe you can walk through this kind of philosophy and process of how you seek to exploit what could be really large inefficiencies. The market is broadly efficient, but what are the edges and the inefficiencies you're trying to exploit with this strategy?
Yeah, there's been considerable asset growth in investment strategies driven by things other than what traditional investment managers focus on. And this has really changed the market dynamics, where 90% plus of stock market action is being driven by non-fundamental investors. And this flood of assets away from traditional fundamental managers has caused many to pivot their strategy and focus and resources away from single stock fundamentals. And at the same time, you've had broker-dealers and large banks that can no longer use their internal capital like they used to provide liquidity when needed. And so this has caused a greater reaction in prices in the marketplace. And performing deep fundamental research and having highly convicted thesis on your companies has allowed us to take advantage of these dislocations and position the portfolio for the long term. So we think, sticking to our knitting of dissecting and investigating individual businesses allows us to take a longer-term view on companies, and then use this volatility and these dislocations, which continuously happen, to seize the opportunity and make investments at, we think, very attractive levels. And looking out beyond the next couple months or year, and really looking at this multi-year time frame for investing. And so being disciplined and having this behavioral edge in terms of focusing on the long term and taking advantage of those short terms benefits the company throughout a business cycle. And we built this portfolio to be concentrated but yet balanced portfolio with having that high active share in very high conviction investments.
So I think as investors, you're always trying to evolve, you're always trying to learn, but as I've told you, you kind of start with who you are. So a couple of quotes I've heard you recently use that really, as you talk to companies, every company is a technology company, meaning that most of their incremental spend is either staying relevant or leapfrogging competitors via tech spending. And the quote that I'd heard you use from the founder of TPG is that we live in this age of the devaluation of incumbency and the rise of insurgency. So I'm going to apply that to technology broadly, but ask you to maybe really dig in a couple levels. So there's many different types of tech companies. Can you maybe give a big picture view of like the verticals that you find to be attractive right now within technology and some of the things that you're less positive on and why, and just give people a sense of how you're thinking both about the fundamentals and the valuations within those kind of key areas?
Yeah, so we continue to be very excited about the opportunities in technology because it's imperative for corporations and governments to continue advancing initiatives to remain competitive. End users and employees now demand a higher experience when conducting business. And this is enabled by technology, which is driving this digital transformation globally and challenging many incumbents who have not kept up with investing in innovation. As a consequence, our strategy has maintained a very high level of ownership of enterprise software companies. So these are software companies like a ServiceNow, a New Relic, DocuSign, or Adobe, which are really fundamental platforms that enterprises are using to transform their business, transform internally and externally. And companies that are not adopting these tools to really transform their business are having a much harder time competing in the marketplace. These business models themselves are very efficient. They have very high margins, very high recurring revenue streams. They're capital light. Their balance sheets are mostly flush with cash. And so they have these very unlevered balance sheets, which allows them to do selective M&A. And also, it's offensive and defensive for these businesses that have these flush balance sheets. They can continue to invest today, but yet in more defensive times, it gives them the wherewithal to continue to invest. They don't have to pull back the reins on innovation because they have the balance sheet support to continue to fund that growth. So these stocks have also been great feeding ground for other larger companies to acquire innovation. So the strategy has definitely benefited from M&A over the years, and we see larger companies continually dip down into these companies and acquire them for their niche technology as well as the human capital, which is so hard to find in these more innovative areas. With a great expansion of application and data, it's equally important to protect these applications and data and our digital assets wherever they may be. So we've also found a lot of opportunity in information security. These are companies that are protecting the walls of the enterprise, protecting, again, those applications, giving key permissioning to certain employees so that some employees have access to information without having it broadened out to everybody else. And so we have found a number of opportunities in this space over the years, companies like a Fortinet or a Forescout or Qualys that, again, are much needed to protect these digital assets. There's this proliferation, and they need to continue to protect it. But to your point, technology is not homogeneous, and we're finding companies that have built their own technology-powered platforms to challenge mature industries, not specific to technology, but utilizing technology to become a technology player. So an example there is a company like Carvana, which is an online used car retailer. They are by far and away the biggest online used car retailer. There really is no number two right now. It's a blue sky opportunity. They have, it's a used car market is a huge market. There's around 39 million vehicles sold offline, with not even 1% of used cars being sold online today, so very low penetration rates. It's a asset-light business because unlike their competitors that have these physical locations where they have retail outlets in all the major cities, They run an asset-light model where you can buy your car, it's delivered to your door within a couple of days. You have a 7-day free trial, and so very good customer service and high net promoter scores. The business is growing roughly 100% a year, and we have very high conviction in the business, even though it's still immature, because in their more mature markets, they've already garnered more than 1% market share, and they're still growing 40% in those mature markets that they've been in. So very long runway for growth, and I think it's indicative of a company that's not a technology company that's really using technology as a platform. Conversely, I'll just say that we've shied away from companies that have driven their business for cash flow to repurchase stock at the expense of these internal investments needed to continue to innovate. And so that's where we've found some good shorts and continue to avoid those businesses.
So I'm going to actually take a Q&A from the board, which is somebody submitted a question. So as you said, being a more unconstrained or opportunistic investor, the idea of thinking globally, right? So the idea of your opportunity set and thinking about when is it appropriate to maybe deviate from U.S. indices or U.S. domiciles and how you think about that. Maybe just think about your approach of investing and where you're thinking about potentially opportunities and how wide is it from a global perspective.
So the strategy is predominantly U.S., but we have drifted outside the borders to find some great companies like a Mercado Libre, which is a e-tailer in Latin America. So we have selectively found opportunities. Most of the enterprise software stuff has been here in the U.S., but there has been some consumer and digital businesses that we have found outside the U.S. We need to have even a greater amount of return capabilities to go outside the U.S. And Mercado Libre, I think, exemplifies one of those companies where, again, we saw what eBay and Amazon did here in the United States. This was an entrepreneur who went to Stanford Business School, saw the inner workings of what was happening at eBay and Amazon, went to Latin America, started to build the business up himself. eBay actually took a strategic business and helped fund their company. And we just saw the very low penetration of online users in Latin America, e-commerce being a fraction of the rate that it was here in the United States, and a more arduous environment for growing e-commerce and logistics within Latin America. So having a company that had really specialized within the region rather than someone like an Amazon trying to go into the region, much more harder for them. There's much bigger moats around the business. So we will go outside the United States to find companies like a Mercado Libre, and we have added a couple actually recently as we have found those markets sold off a lot harder than the U.S. markets. For now, all the companies that we have invested in that are international have been predominantly listed here in the United States. So these are U.S. listed companies with the majority of their business being outside the United States.
Right, because Melly, for example, trades on U.S. exchanges, if I remember right. Yep.
Yeah.
Great.
And same with Baidu.
Yep. So one of the differentiating elements of to me, the strategy and Clearbridge strategies generally is this kind of spectrum or continuum methodology. And I think why that's the case is it's not easily replicable by factor strategies. It's not one size fits all, and I'm trying to find a portfolio with a common set of characteristics. I'm really trying to look at it from a diversified perspective. So each team has a different way of viewing this. So maybe just explain to this on Select and the listeners today your thought process behind this slide, and maybe give a couple stock examples that you think embody each of these kind of verticals within the portfolio construction framework.
So starting from the top of the pyramid, the disruptors have represented roughly around 45 to 50% of the portfolio. And these are the very innovative businesses that are generally creating new business markets that didn't exist before. These are companies that are growing greater than 20% a year. They have huge secular tailwinds. The how big is kind of our key question, and we're keenly focused to make sure that the moats of the business are protected, because it is still early days. But the disruption that these companies are causing provides a decade growth opportunity that we think are just too hard to ignore. And those companies are, generally speaking, also more insulated from the ebbs and flows of the economy, because they have such low market share or are creating such a dynamic market that didn't exist before, that these companies can generally grow right through a recession. So that is represented around 45 to 50% of the portfolio. The next level down is the compounders and durable growth companies. And these are companies that are in more mature industries. They have grown rapidly over the years and have kind of settled in something generally between the 5% to 15% growth range. They're leveraging years of investment they made in sales and marketing and product innovation, but they're just in a more mature state or more mature industry that just isn't ripe for that rapid disruption. And so that has represented around a third of the portfolio. An example there is a company like Trex. Trex is a composite decking company focused mostly on the residential market. So for those of you that have had wood decks in your backyard, you know what a pain they are in terms of maintaining them. They're splinters, you need to sand them, restain them, and they generally last around 7 years before you have to rip out and replace them. What Trex has done is they've produced a more environmentally and easier to maintain product where they take plastic wrap and wood chips, melt them together, infuse pigment, and extrude them out into various grades of quality of composite decking. These decks over their life cost half the amount of wood, but yet they last 2x as long. They have a 30-year warranty provided by Trex. So the decking market is quite substantial. The composite decking market is around 20% of the overall pie, and they've been growing a point a year with Trex the dominant player in that space. They're encroaching more and more market share away from competitors in Home Depot and Lowe's. They're one of the best manufacturing teams we've found, and so we think that they can grow sales double digits with operating efficiencies that will drive earnings growth close to or above 20% a year. So a nice compounder within the wood decking space. Moving further down the period, the evolving opportunity stories. These are companies that are a little bit more on the value side. They are not competitively challenged businesses, but these are companies where maybe they've deviated from their core strategy a little bit. Maybe they stubbed their toe on an acquisition. There's some sort of change underway where they are fundamentally improving the business. There might be a new manager that's taken over the company that sees a better direction. The valuations are cheap. And so as a consequence, we see that these are companies that could be substantially re-rated higher on better fundamental numbers and a higher multiple. And so an example there is a company called Cardtronics. They are the largest operator of ATMs outside of the major banks. They operate a network of around 40,000 ATMs. If you've ever walked into a Target or a Walgreens, you might have seen that ATM up near the front of the counter. Chances are that is one of their ATMs. It won't say Cardtronics on it. It will say PNC or Citigroup. So most of those ATMs are branded by a bank that's paying for that advertising. And really the opportunity here was that we saw a company last year that was upgrading their ATM network for some new regulation, chip and PIN. They also made a number of acquisitions outside their core competency in international markets, and they put a decent amount of leverage on the balance sheet. And that was all way too much to bear. The CEO stepped aside. We had a new CEO come in that said they were going to refocus the business on the U.S. opportunity, that it was quite substantial, and they had kind of deviated from that. They were going to focus on paying down debt. And so we saw a company that was substantially mispriced, where the fundamentals were starting to turn under a new management team. And so we bought a sizable stake last year, and it's been a nice return for investors, but we still see a long runway as retail bank branches are closing down, and they need to continually provide cash to their user base. And so as a consequence, they're outsourcing their ATM networks to Cardtronics. So a long-term play here. So having this balance of opportunities that we're finding in the portfolio provides a nice balance within choppier markets as well as more robust markets.
And then the last thing, maybe just to follow on, because one of the things I think is important here is a lot of people think of maybe alternatives as hedges to the portfolio, but one of the things you've talked to me about is the alternatives, and what we might look at here is things that make us more informed and better about what we own currently on the long side within our portfolio. So could these be private companies that are disruptive? Are there things that we're just concerned about? Is there better entry points? So maybe just talk a little bit about the philosophy of how you think about that last part of the pyramid.
Yes, the last part of the pyramid has generally represented 10% or less. It has an amplifying effect, as you pointed out, on the rest of the portfolio. Contained in this segment of the strategy is everything that's not going long common equity. So that includes some private investments, that includes looking at fixed income securities, that includes looking at investing in options, as well as shorting common equity. And it all, our work all goes back to analyzing a particular company and then figuring out what are the available instruments that we could look at that will give us the right risk reward by gaining exposure to that company. And so we spent a lot of time, as you pointed out, meeting and talking to private companies. The majority of our economy is driven by private companies, not public companies. So having an understanding of what's going on in that marketplace is very important. It positions us to find great IPOs when they're coming public, or maybe making an investment before they go public. And then it also makes us sharper about the companies that we own, because those private companies are the ones that are nipping at the heels of our public companies. So understanding what sort of innovations are taking place at those levels, who's well capitalized, who's struggling, makes us smarter about the investments that we're making on the traditional long common equity side.
So last question I had, unless more come in, I saw another question come in, and it shapes no doubt everybody knows Clearbridge as a bottom-up fundamental investor. But clearly, I think with the way the market has behaved recently, I think it's important to maybe think about what you're thinking about from an outlook perspective. So maybe just, can you comment on what beyond your company holdings you're paying most attention to, and what key things you look at either at the economic, fundamental company, or market sentiment level that shapes portfolio construction today?
Yeah, so there are two major intertwining dynamics that we've been following the last handful of months. The first is sort of just the general complacency in the U.S. market. There's been a broad sweeping global recovery that was taking place, and then we started to see that come unhinged in Asia and the emerging markets, and we were a little fearful that could only last for so long before there was some sort of ripple effect. The tax rate benefit that we experienced in January and early parts of the year was helpful, but we knew that wasn't going to recur, so there was a little bit of euphoria around that. And then we were definitely witnessing some building inflation in the companies that we were talking to. It was just harder to recruit certain talented labor. People were experiencing inflation in terms of on the freight side and moving logistics things around this country. And that was there was sort of just this lack of volatility, which was driving increased valuations in momentum stocks. And our disruptors definitely fell into that a bit. And so we started to look at the companies that we were owning and understanding the multiple expansion that had occurred for a couple quarters there, and it was really starting to feel uncomfortable for us in a number of securities. So we exited a couple companies, and we also reduced our exposure. I think technology maxed out around 55%, kind of had a little bit of a super spike there in early summer, and we started to really take some aggressive action in reducing our exposure to technology, which today sits around 30%. We were also looking for more self-help stories, companies that were going to be a little bit more insulated from what was going on the macro level, because there were more company-specific drivers that were taking place. And again, a company like a Cardtronics or Yelp, these companies have new initiatives underway. They've made some key investments, and we think those are going to start to bear fruit. So we shifted some of our exposure away from the disruptors and away from technology to other areas of the portfolio. Subsequently, we've had this big sell-off. There's been this market unwind, which always starts orderly and then starts to snowball. Again, the big market movers in terms of stock prices when something like that takes place is not really the fundamental investors. We're doing things kind of trying to advance to that and then taking advantage when something like that happens. It's mostly the momentum guys, the momentum investors, the technical traders, the CTA and risk parity guys, and then there's the deleveraging of hedge funds. And so through that consequence, we've seen a lot of exposure come off here, and now actually starting to see that come back as kind of the decks were cleared. But through that process, we saw valuations that we have not seen in several quarters, some a year or two since. And so that's caused us to increase some of the positions that we had at the bottom of our portfolio that we had taken a starter position in, and then valuations kind of got hot, and we said, we were not interested in buying at those levels. So we're significantly increasing some of those positions at the bottom of the portfolio. And we've definitely been rotating around some areas that have held up really well, and we're just seeing that there's better opportunities elsewhere in the portfolio. And we're also dusting off a lot of names as well that we had looked at earlier in the year that we thought that there was risks and an underappreciation from some of the fundamental factors that we thought would play out later in the year. And as a consequence, some of those stocks are down 30-40%. And so that's giving us some opportunities.
And that's, I think, an important point to highlight, because you talked about this as you'd done some meetings in October talking to people about how they should think about allocating the strategy. And you said that exactly what you did in the portfolio, which is maybe start with a starter position. Let's see how the volatility plays out, and let's increase those positions as that happens. So I think that's important to kind of take away for the listeners. Maybe a related question to something you said before, which is around being disciplined and having a long-term horizon. And I think the hardest part in a world where investment time horizons are so short is the ability for the advisors and clients to articulate that line between being disciplined and being stubborn. And so maybe just think about how you would articulate to people listening how you think about self-discipline, how you go about evaluating a story, knowing that nothing can go just straight up, unconditionally for 5-10 years, how that assessment of a company that's taking a pause or that type of thing, or like you said, a Cardtronics where you're kind of stepping in and trying to figure out if that growth trajectory is permanently damaged or something that's more of a short-term issue. How are you going about really doing that, and how are you maybe moving aside on a name when you just say, kind of think I was wrong on something, or it hasn't played out the way I thought?
Sure. So when we're doing our work on a particular company, we're keenly focused on identifying what are the key risks. And what are the key risks? Where would we start to see those unfold? And what would be the impact if those risks played out in the stock price or the investment price for what we're looking at? And so during that de-risking process, that always keeps our antennas up in terms of looking for those particular things. And sometimes they crop up in areas that you didn't expect, and they need to get added to the mix in terms of something that's unfolding. The primary reason why we sell or reduce is that the risk reward is no longer there. So we want to make sure that we always have an asymmetric risk reward where there's more upside than downside. And at time of initiation, that's 2 to 3 times the upside versus the downside. Oftentimes what will happen is that there is this perceived challenge to the business or something that investors don't like. And we need to quickly go in and assess, is this something that is short-term in nature? Is this something that is real? Is this something that will impact the real long-term value of this business? Or is this the opportunity that we've been looking for? So just a topical example of something that's playing out today, one of the companies that we own that is in the diagnostics and test area, without going into too much detail, they actually saw their core business accelerate in the quarter, and they've now raised their organic growth expectations for the year. However, they slightly missed revenue and earnings due to 2 dynamics. The first dynamic is foreign currency, which we've had some big swings in foreign currency, and we don't place too much weight on foreign currency swings because is something that we're cognizant of maybe when we're adding and managing position size, but foreign currency can ebb and flow, and we're looking at the foreign currency neutral. So we give them a pass on that. The second element is that they've executed very well in the first half of the year, and after beating numbers on the Q2 earnings call, the stock rose, had a nice pop, and as a consequence, when they reported numbers for the second half of the year, they are taking a greater reserve for executive compensation due to stock-based compensation. So big increase in rise, they now have to make an accrual for that. That's a good thing. We want the stock price to go up, and we want it to go up because the management team is outperforming. So we take a look at that and say, well, they're beating on their organic numbers. They've guided higher in the year. We've got this solid pipeline of new products coming out, new tests coming out in 2019. It's shaping up to be a better year next year than we originally thought, and the stock is down around 7-8% this morning. So we've been aggressively adding to it. So I think those are the situations where you have to go in, quickly assess. Yes, maybe the numbers overall don't look like what we thought they were going to look like, but what's really the root cause, and has anything fundamentally changed? In this case, it hasn't. In other cases, we go in and assess, and there is competitive encroachment. And we don't think that that's slowing down. Maybe there's some deterioration in just the overall business model, where the returns in the future are not going to look as good as they do today. They have in the past, because they're tapping out their addressable market, and they need to invest in other new businesses that are going to be less profitable than their core. That would cause a deviation of thesis, and we would need to address that quickly.
Great. So we're right at 12:40 Eastern Time. I think that's the submitted questions that we have as well. So I wanted to thank Aram for going through with his clarity, with his clear detail on kind of the philosophy, process, stock examples that I hope are there. One of the things, obviously, the strategy, if you look at any screens, whether it's in a Morningstar peer group or a Lipper peer group or an investment peer group, it's going to look very good. What we hope we accomplish today is really understanding how we think about the market, how we think about portfolio expectations, how we think we're very different than a lot of our peer set. So I would encourage you, there will be a replay available. There may be questions that came to your mind afterwards that you didn't get a chance to submit. I would encourage you to follow up with your Clearbridge or Legg Mason representative. In these volatile markets, one thing we know that we can stand out versus our peer group is the quality and speed of our response time. So we thank you for your time today, and with that, good night and good luck.
Thanks to all of our participants for joining us today. We hope you found this webcast presentation informative. This concludes our webcast, and you may now disconnect. Have a great